Now, going back into a recap of the year and what we did during the course of the year, there were three businesses that we completely exited, as well as one where we took out partial money because the portfolio did well, or the portfolio investment did well. We'll fully cover the three businesses that we completely exited. First was Infosys. The exit was done in two tranches, and it was done across all clients. From a background perspective, we started first buying Infosys back in 2017. While that memory seems to be distant, this was the time where there was an issue with the CEO and there were issues around the board, and there was a great opportunity for us to start building exposure into Infosys. We continue to add that exposure into COVID. Now, we were getting what was the rationale for us to buy into this and build exposure into Infosys? The largest tech services company in India at a potential base IRR of 18% is what we were looking at. Even at a conservative growth rate of 10%, it didn't look like we would lose money where we bought. During our holding, during the period in which we actually held the business top line grew by almost 18.2%, which pretty much for an IT services company translates into cash flow growth. The IRR investment that we realized on our exit was 31.2%. The exit was purely on the basis of risk reward in terms of where we saw future growth versus the baseline IRR that we expected on the investment. What does that mean to us? When we bought the company, even at a downside of 10% growth, it didn't look like we would lose money. Today's valuations, where we see future growth, it does look like there could be more downside. But more importantly, even at a base case growth rate, it doesn't look like we can look at more than a single digit or a double digit IRR at best. So there is always a need for saying, why do we need to hold on to businesses at a 10 to 11% IRR? Because that's not the objective of this fund. Hence, we had exited half the position somewhere around Jan 2022 and the remaining half during the middle of the last 2-3 months. Second business that we completely exited was a small cap company called Fine Organics. Background of this company, the company was manufacturing specialty chemicals, which is predominantly used by B2B businesses across food additives, plastics, textiles, rubber, and pharma. And they had carved out a unique niche for themselves, especially in the green additive space. As companies move towards oleochemicals from synthetics, the very few companies in India have the ability to manufacture green oleochemical based additives, and Fine Organics being one of the few, basically along with the clean balance sheet, after our multiple interactions with the promoter, because the promoters are very reticent, they do not talk much. That's when we decided to start looking and evaluating the company. Why did we decide to buy it? Obviously, the promoter owns majority stake in this company, 75% ownership. They had come out with an IPO back in 2018 to 19, and post that, it was around COVID, is when they went into a capex. So obviously, they got punished predominantly because there was uncertainty and they were actually expanding. The interesting thing about such businesses is B2B businesses, by their very definition, are extremely sticky in nature. What does that mean? It takes time to actually build that relationship, but once you become an approved vendor, because you go through multiple quality checks and you're supplying to global companies, you tend to expand through their growth. As a result of which, if the balance sheet is managed well, you have very sticky and consistent return on capital employed. And along with the fact that they had just finished the capex, the capacity utilization could have expanded. And the rationale for us at that point was, at the valuations that we were getting, we were looking at a potential IRR of 24% on the base case. What was the outcome during our exit? During our holding period, which was roughly slightly over 1.5 years, the company grew its top line by almost 38%, which was unprecedented, which was much higher than what we had anticipated. And to that 38% top line, what we actually realized on the IRR was close to 69%. So obviously, why did that happen? That happened primarily because of A, execution, B, great return on capital, the margins expanded, and C, the PE is well re-rated. Purely on the basis of valuation, we've exited the business. Obviously, the company has fallen since the time we've exited, but that's besides the point. The point effectively is when the IRR that we realize is way higher than what we think that the growth rate of at the future can be, we will obviously evaluate saying, does this necessitate us to continue with the exposure or not? We still believe that the company is a great business, promoter is a technocrat, and he continues to deploy capex. But at today's valuations, we think things are fairly priced for this, and hence we've completely exited the business. Third is a business of third business. We've covered this in prior calls, but again, we thought just highlight this. This was again a complete exit. Online BPC was the primary reason why we entered Nykaa. It was a starting position that we actually took. When I say starting position, typically it's 2 to 2.5%. That's how we start off. Predominantly because of Nykaa and entering into their own products, which is what is called private labels. We saw potential for the gross margin to expand from 44%, which is when we started buying, to potentially 60%. And that's how the evolution of private label brands happened. Now, the rationale for the exit happened around three facts. A, they did not focus on private labels, which is what they were going to focus on. In fact, most of their capital allocation went into fashion and saloons, which are categories which are capital decelerative in nature rather than accretive in nature. And there were a few exits of category leads in the private label category, which is what we were backing. And during our holding period, though the company grew its top line by 24%, the cash flow of the growth of the company was flat. Predominantly of these two segments, they reinvested capital in, and we decided to take a loss, even though it was at 34%, because the core levers that we were looking at for growth didn't materialize. So the risk management was purely on the basis of the position being a startup position, but in terms of execution, when we don't see things happening on the ground based on expectations, we will exit.